This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Sleep down in the soil. Nothing come from nothing. Come on, Royal oil.
All right, everybody, we are going to stay a little bit with the markets here because we kind of touched on it with Katie and Romaine, but we want to talk a little bit about what's going on with Brent. We said it's, the international crude benchmark climbed to within a nickel of $95 a barrel today. You got crude futures as they went higher. Traders and analysts are increasingly talk about when and not if prices return to $100 a barrel. I remember $140 a barrel way back when.
What came after that, Carol?
I don't know.
Wasn't there certain...
Oh, it wasn't good.
Yeah, it wasn't good.
Oh, sorry. I'm like, what do you mean, Tim? What do you mean?
It wasn't a good thing.
No, and I think it's interesting in terms of we've got the FOMC meeting, and we always talk about, core inflation. We take out food and energy, but I do wonder what it all means. So let's get to our market roundtable. You put me on the spot there.
Sorry, I was just thinking back to financial
here,
crisis. You don't have those oil numbers memorized. It's okay. I have the charts in front of me.
All right, with us is Bloomberg News international economics and policy correspondent Michael McKee in our Bloomberg Interactive Broker studio, along with Dr. Ellen Wald, president of Transversal Consulting, senior fellow at the Atlantic Council. She's also author of Saudi Inc. She is with us on Zoom from Jacksonville, Florida. I do want to start, though, with the crude story first. Ellen, Brent crude up some 12% or so in the past 3 weeks. We talk about strong demand and supply curbs by Saudi Arabia and Russia, which are huge oil powerhouses. What do you make of the move that we've seen in oil prices broadly, and what are the trends that you think we should be paying attention to as investors, and that the world should be paying attention to?
Yeah, I would say that there's what we're seeing now is not unexpected. When Saudi Arabia makes a pretty bold move like this to say, hey, we are going to be restricting our oil production by, 1 million barrels a day, basically through the end of the year, that's something that the markets are going to pay attention to. So it's not surprising that we are seeing prices rising right now, especially because, there are some other issues in some other countries. We're seeing some stoppages in Libya due to flooding. So it's not just the Saudi story, but it's definitely having an effect on prices. I think the key really, I think here to everything is really to look at why Saudi Arabia is doing this and what signals they're looking at. And they are really focused on China. And I think the fact that they are concerned about demand says something about their concerns about China. And the Saudis, I think, are very, very keyed in to what's going on in China. They have, Aramco itself has a lot of joint ventures in China. They own parts of refineries. They have contracted, to supply certain amounts of oil to China. They've got, students in Chinese universities. I mean, they are really enmeshed, I think, in China. And so if they are seeing signals that they think show some weakness in Chinese demand, or at least things that they're not comfortable increasing production, that they think that there could be some weaknesses, I really think that that's something that we need to pay attention to. And you can't just assume that China is going to have some kind of comeback. And so that's really, I think, a number one thing to pay attention to. And then the second thing I would be looking at now really is how you brought up the Fed, how they're going to respond to this, because if you looked at what happened in August, really essentially there was this, they're blaming the fact that inflation didn't drop as much as they had expected, or went up more than expected simply because of oil prices. Mm-hmm. And I think that's both, oil definitely can be a cause of inflation, but it also is impacted by inflation. Oil production can be impacted by inflation, and the Fed is not going to just abandon their target simply because oil prices are higher than they thought. Perfect.
Well, I want to bring in Michael McKee, international economics and policy correspondent. Mike, and just respond to that, the idea of high oil prices making the Fed's job more difficult.
That makes the Fed's job more difficult, but she's correct. The Fed isn't going to abandon its targets because of oil prices, because they can't bring oil prices down. Now, if oil prices start to do what we would call getting into the economy, starting to affect inflation perceptions and what consumers think inflation's going to be, so that we start to see inflation expectations unmoored, then the Fed might act to send a message, but that's a long way down the road.
But come on, if you go to the pump and you fill up your SUV and it's $5 a gallon, you're thinking things are pretty expensive, Mike.
Sure, but what can the Fed do about that? That's the problem.
Yeah.
They can raise rates all they want, and it isn't going to bring down oil prices. But, well, I'll back up and say, yeah, you could put the economy into recession. It would bring down oil prices because nobody would be buying oil, and people who are no longer going to work would not be buying gasoline. But the other thing is we have a sort of situation where every time oil prices and gasoline prices in particular, because that's how it's reflected to the American people, go up significantly, they have to go higher to really affect consumer behavior. Since we had $5 gas, people are going, yeah, gasoline prices are up and that's terrible, but it's only $3.87 or whatever it is. So we will, we'll still keep going. If you get over previous highs, then people really start to get concerned.
I actually do that when I'm like, well, it could have been, or when I'm filling up. Mike, one thing I want to ask before we go back to Ellen is, I also though think about the cost of this into transportation companies or just companies overall. Like, how big a factor is it in that companies then pass that on to consumers or their customers in the form of higher prices? And that's another aspect of
it's
inflation.
interesting because that should be passed along. It has been in the past. They put on a fuel surcharge, the trucking companies and the railroads. But we've also seen a decline in truckloads lately as the economy has slowed a little bit. So that offsets it a little bit. It also takes a while, again, to get into the economy. And the question the Fed can't answer is, how long are oil prices going to remain elevated? If China's demand falls, we saw U.S. gasoline demand fall dramatically last week. If that continues, then do oil prices stabilize or start to come down?
So, Ellen, what are you watching? Let's say, I don't know, what is the right timetable in the next few weeks, in the next month, in terms of kind of how the energy markets settle in, or the oil markets specifically settle in?
Yeah, well, I think that, we're already seeing prices kind of retreat from highs that we saw earlier in the day. So I'm not sure that, $100 a barrel is right around the corner. Yeah, we're pretty close. And say, a hurricane comes and threatens, production and refining and Gulf of Mexico platforms have to shut down. Then, yeah, we could definitely say $100. We could see triple digit oil happen very quickly. But that's a temporary thing. That's a kind of a temporary shock to the market. And doesn't necessarily reflect the longer term conditions that we're seeing. So, I wouldn't, like fasten your seatbelts just yet. And it doesn't look like there are any hurricanes coming towards the Gulf Coast, in the foreseeable future. But I do think that we do need to look at how the economy is going. If this is going to affect the economy, I think it was interesting that the Chevron CEO kind of made a bit light of what's going on and the high prices. I mean, people in California are seeing prices over $6 a gallon. And, they're looking at this and saying, yeah, I got to fill up my car. But whoa. Obviously, at a certain point, they're going to be, more and more people are going to be saying, I can't actually fill up my car. I can only put, half of what I really need into my car because I've got to pay for groceries, which are a lot higher, and rent and electricity.
Or maybe
and
I won't
all
take that road trip with the kids because it's going to be expensive. Chevron CEO Mike Roth actually talking to our Alex Steele, great interview, and I highly recommend everybody check it out on the Bloomberg. So Mike, come on in as we, this is part of our backdrop that the Fed is going to be dealing with, though, on Wednesday. What do you think, though, will be front and center when it comes to the Fed on Wednesday?
Well, the question of whether inflation is going to be front and center, because that makes all of their decisions and at this point. And they don't have a good handle on what's going to happen. And they have not just oil prices, but you've got student loan repayments coming up now. You've got whatever is going on in China's economy. You have the potential of a government shutdown. You have the UAW strike. There's a lot that they can't forecast at this point. So they're probably going to stay on hold and say they will remain vigilant against inflation, because that's about all they can do at the moment.
Very briefly, Mike, are any of these external forces that you talked about making the Fed's job easier? If you have people paying back student loans, they're not going out and spending as much money on other things.
Well, yes, but then that slows the other parts of the economy. We have seen people paying back student loans at a very fast rate for the last month, which is unusual because they didn't have to yet. So does that mean it's not going to be as big of an impact? That's one of the open questions.
Good question.
All right. Well, folks, thank you so much. Really appreciate it. Our Michael McKee, Bloomberg News International Economics and Policy Correspondent, getting ready for, it's like the Fed prom. How many proms a year?
I get out, well, there's 8 a year. I get out of New York City during UNGA week.
What do you mean you get out of it? Do you leave?
I'm going to Washington.
Oh, that's right.
To cover the Fed. Thank you,
all I'm
Jay
saying
Powell.
is careful
I don't
of the
get stuck in
subways
the
on the
traffic
way.
jams that
This is
you
why
guys are going to be stuck
Mike
in.
is a wise man.
I've spent
Always
much time
is.
already today getting stuck.
And our thanks to Dr. Ellen Wald, President of Transversal Consulting, Senior Fellow at the Atlantic Council, a go-to when it comes to the energy markets.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
I will buy you a garden where your flowers can bloom. I will buy you a new car, perfect shiny.
All right.
And listen to the words.
You can do. Why?
Because
Okay. We got.
about buying.
Yeah.
Paul Brennan, thank you so much. Our producer, man.
We don't have to look
Picking
too
out some
hard
music.
to look at the meaning behind why certain songs are chosen in certain places. We got a great team.
We do have a great
Yeah.
team. We have an amazing team, and we love.
So-
can you talk about business school?
Yeah, when I went to
school.
business school a few years ago, everybody wanted to work at the big three. That's where their classmates wanted to go. We're talking McKinsey, Deloitte, BCG. The ones who didn't go into consulting, they wanted to go to finance. There were some of my classmates who went to work at Tesla and Apple, but they were kind of few and far between. There were a couple entrepreneurs, but it was all about consulting. One thing I never heard throughout my time there was someone starting a so-called search fund, raising money to find, acquire, and then run a small business.
Well, the search fund is becoming a more common path for business school graduates. Who knew? Well, our Matt Boyle knew. It's called Entrepreneurship Through Acquisition, or ETA. Matt is Senior Management Workplace Reporter here at Bloomberg News. He writes about it in the upcoming issue of Bloomberg Businessweek Magazine, which you can read now on the Bloomberg and at Bloomberg.com/Businessweek. He joins us here in our Bloomberg Interactive Broker Studio. What is this about?
Well, this is
And
about.
how new is it?
It's not entirely new, but it was not very well known for many decades. It started all the way back in 1984 when a guy named Irv Grousbeck was basically just helping a couple of Harvard Business School MBAs who had sort of had a fledgling kernel of an idea. They didn't really know what to do with it. They knew they wanted to run a company, though. And so he helped them come up with this sort of investment vehicle, which was not even called the search fund then. I asked Irv, did you coin search fund? He said, no, I don't really think so. Irv's a great guy, by the way. But Irv then went from Harvard to Stanford Graduate School of Business and took the idea there. But for many years, it was just sort of a smattering. A handful of students would do this. People who didn't want to go the traditional corporate route, but who also didn't want to do the traditional startup route where you found your own company, you create your own company, in the proverbial garage, Hewlett Packard, et cetera. These are people who want to buy a company that already exists. It's already profitable. It's a small business. It's not going to cost $10, $15 million.
What kind of companies are we talking about?
Traditionally, we're talking about small local businesses, plumbing companies, pest control companies. But what's interesting, Tim, is that it's really evolved outside of that to now look at more like technology companies, B2B software companies. One guy I talked to said he's looking to buy a software company that automates insurance company billings. Very boring, but very profitable.
Go ahead, Carol.
Well, what I'm curious. Well, go ahead.
I was going to say the hard part about buying a business is it's a quote unquote efficient market. So you buy it based on, this is what they teach you at business school, right? You buy it based on future cash flows. So it has a valuation. So you have to bring something to this business that makes it more efficient.
Exactly.
You have to squeeze more money out of this business or improve it in some way. How are these guys doing that?
They're doing so by taking over a company that, let's say, was founded decades ago by a guy who's, a woman or man who is now into his 60s, maybe looking to retire.
Like a family business.
Yeah, a family business, a passion business. These people are looking to just basically run them better, more efficiently, to bring the tools that you learn in business school to a business that maybe it's making money, but it probably could be making better margins, maybe it's a bit bloated in payroll, maybe it's not doing a good job in marketing. And so these MBAs apply what they've learned at Harvard, Stanford, Yale, Wharton, and they also work with investors. So you have advice coming from outside. So it's not just the ETA searcher who has to come up with every idea. They have help from investors who are putting their money into the business, and then they try to really grow it and then sell it eventually down the road.
It sounds very private equity like, because I often
It's
right?
almost like mini
Just thinking
PE.
that.
It's mini PE.
It's exactly. Well,
Yeah.
so that's what I was curious about, is where they get the money, right? I mean, Tim graduates and he says, I want to do a search fund.
It depends. There's two ways you can do it. You can gather a group of investors who will fund you initially for about a couple years, your admin costs, your travel costs, because it costs money to search around for these companies.
Right.
Or you can do what's called self-funded, where you are, funding it yourself. Let's say you've worked in corporate America for 10, 12 years. You have some savings. Maybe you have some money from your family. You might use that to plow into the search. And then when you're ready to buy the company, you take out an SBA-backed loan. So that's self-funded, or you can go through investors. And those investors, you might have a little less autonomy if you're going through investors, but you will have the advice and networking capabilities that those investors can bring.
So Matt, you got some data on how well these companies did post-acquisition.
Everything's a success, right?
Yeah, everything.
Success.
Not
100%.
always. So first off, not
Sarcasm.
every search leads to an acquisition. So that's the first thing. You might not find, sometimes it's needle in a haystack, and you might not even find a company to buy.
Yeah.
But those who do find a company to buy through a search fund, nearly 3 out of 4 who did an acquisition made a profit. And the number of annual exits, when you eventually sell your company, the ones that generated a positive return hit an all-time high recently. This is all data from Stanford, which has great tracking of search funds and how well they do. Also, who takes part in searches. This is traditionally a very bro-tastic type of sector, a lot of white guys. But it is getting more diverse, thankfully.
Yeah.
The number of women searchers has more than doubled, from 5% to 13%. We're seeing more Black and Hispanic searchers as well.
Is there certain MBA grads or MBA students who are doing this a lot? Like Stanford, that's the environment. Like they're either people
there
are
are
starting
certain
companies
environments
or
that are
investing
very
in it.
entrepreneurial. Stanford, Babson is also really a great home for entrepreneurs. I did talk to them. They're not in the story though. But this is really percolating outside of the sort of the traditional entrepreneur hubs. I mean, any smart MBA who's just thinking, well, maybe the corporate life's not for me. I have an appetite for risk. I really just want to run a company. This could be for them.
Hey, talk more of the motivation here behind this, and why the corporate life post-pandemic might not be
Well,
for some of these
we all
folks.
know what's going on with hiring at the big three, McKinsey, Bain, and BCG, and not really hiring as actively as they were. A lot of consulting and tech companies are pushing out start dates as well. Don't even get into the layoffs. So the hiring, entrepreneurism always gets a little bit more popular when the traditional hiring avenues slow down, Tim. But this is more than that. This is really like sort of this gospel of ETA is spreading. Go on Twitter for ETA Twitter or SMB Twitter, small, medium business. SMB Twitter is just really
It's
a fascinating
crazy,
little niche of Twitter.
I've done some poking around there. It
Yeah.
shows up in my For You thing.
Exactly.
It
You
seems
got
like,
guys
it seems like
talking-
you're the only one without a business.
Yes, exactly. Everyone's got a business. These brokers are all over the place. I'll find you the right business.
Then there's the lawyers too.
Yes,
who
there's
help
a
you
whole
with the
ecosystem.
deals. They have
As you-
newsletters.
Yeah. But it's really fascinating.
Let's start something, man.
What do
I
you
was
want
just
to buy?
going to say, because I'm not a bro, so you two can do it.
No, not me. I'm
having
the last
said,
guy.
Having said that, I am curious about the schools. Are they then, MBA schools, business schools, kind of adapting their curriculum?
They are.
because of
They're
this?
adding classes. Basically, Wharton now has 2 MBA classes for ETA and an undergrad class as well. I talked to the head of their entrepreneurship center there. He said alumni were screaming for ETA because there was no real, curriculum. But it's beyond that. Again, it's not just Wharton and Harvard and Stanford. Schools are adding not just classes, but also clubs, meet and greets, informal things where somebody who has bought a company will come back, talk to the MBAs and say, this is how I did it. This is what to avoid.
That's pretty cool.
Because again, this is not for everyone, but
Right.
there's also a lot of military veterans, people who are used to uncertainty and risk and are very good at leading people. So there's a lot of vets as well in ETA.
Yeah, love that.
There were a lot of vets in my class.
So don't you start talking about an ETA.
No, estimated time of arrival is the only ETA.
That's what I thought it stood for.
I've
mess with
never
these
heard of
days.
this, and
Yeah.
it's kind of wild that it's been around for a while.
Yeah, it's great.
When there's a story like this, I always think about our audience. We've only got about 30 seconds left or so. What do you think they need to understand about this? or know about this?
They need, well, I mean, just knowing it's out there is good. Need to know that they also, you can get advice. You don't have to do this on your own. There are people who've gone through this, who've done this, and whether this is former researchers or investors, academics, professors as well can help. So there is help out there. But again, this is something that you really do need an appetite for risk, and you really want to just sort of be in charge and take a business and turn it into something better.
I also wonder about valuations. Is it just another group that's bidding after companies, right? There's just so many people going after
the
this
big
niche of
exactly
companies.
the big PE firms are now sort of horning in on some of these local businesses.
Yeah.
So there's more competition. So valuations are creeping up.
Who knew?
I didn't know.
Don't get any ideas there, buddy.
Then what do they do with it, right? Do they keep it? Do they go sell it to private
Spin it
equity?
off,
They
right?
spin it off?
They usually will sell it. Who they sell it to? It's not a traditional LBO. So you're not just. I mean, the thing is they're running it. An LBO firm is not running
I love
usually
it.
what they buy. This is what I like about this. You're running it. You're making it better.
Matt Boyle, always love when you stop by. Senior Management Workplace Reporter right here at Bloomberg News. Matt, thanks.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
There's a lot going on. We talk about the traffic because it's the annual gathering of the UN General Assembly. And
Are these all EVs, Carol, that are snarling traffic?
I'm not sure they are. Probably a lot aren't. And, the UN has 17 SDGs, Sustainable Development Goals, and that includes one about ensuring access to affordable, reliable, sustainable, and modern energy for all. And this is at a point where many people, almost 700 million, still live in the dark. But we're making changes. We're trying to make it improvements.
Yeah, that's the bad news. There's some good news, though. Modern renewables power nearly 30% of electricity, but remain low when it comes to heating and when it comes to transportation. With more on global, renewable energy, and everything happening in the space, very pleased to have with us Sumant Sinha, founder, chairman, and CEO of the nearly $2.3 billion renewable energy company Renew. It trades in the U.S. as an ADR under the ticker RNW. Sumant joins us on Zoom from New York City. Sumant, how are you?
I'm good. How are you guys doing?
Yeah, we're doing pretty well. I mean, whenever we hear about renewables, talk about renewables, what comes up over and over again is storage. It's great during the day when the sun is shining and when the wind is blowing and when the rivers are running. But how do you store all that energy for when it becomes dark?
Yeah, so you're absolutely right. Renewables are intermittent. But I think what's happened is that over the last few years, technology has evolved so rapidly that renewables have become really, really cheap. And what that means is that there's enough room for us now to have battery-based storage or pumped hydro-based storage to come in to actually help balance all this intermittent renewable energy capacity. And what we've done in India is we've pioneered a very interesting kind of a technological solution where we're actually able to, using only renewables, wind and solar, we're able to give solutions that are almost semi-firm power. And in that, we use very little amounts of storage, mostly batteries, but essentially combine the wind and solar together in such a way that we then put into the grid power that is 80 to 85% firm. And we are able to do this at a price which is still significantly cheaper than, let's say, coal-based power, which is the alternative in a lot of emerging markets, including in India. And so I think that this is possible because, of course, renewables have become so cheap, because the cost of storage has also come down, because we can technically find solutions that are quite attractive. So I think this is really the direction the market is evolving in, and eventually will allow us to replace fossil fuels almost entirely in the grid.
Well, it's interesting. Spending some time out on the water, and I came into the wind farms that are out off of some of the islands, off of the East Coast here in the United States. And I was kind of like, wow, it was really interesting to see it at work. What is the most productive and efficient renewable energy? Is it solar? Is it hydro? Help me understand really what makes the most sense. And is it different for the developing world versus the developed world, where there is the old infrastructure for fossil-based fuels very entrenched?
Yeah, so what happens is it really depends on the natural resource in a specific area. So for example, in certain countries which have cheap land or let's say lots of desert area, solar radiation is very good. In those countries or in those areas, perhaps solar becomes really, really cheap. In other geographies where, let's say, the wind is blowing, for example, in the Midwest of the US, wind speeds are very good. And so in those areas, having wind is a lot cheaper than solar. So it really depends. It also depends a little bit on the transmission infrastructure, because if you have to carry all that power away into other areas where that power is required, then the cost of transmission also becomes a factor.
Right.
So it really depends on different areas. I would say that in general, however, offshore wind is more expensive than onshore wind or onshore solar. The only way it makes sense for offshore wind turbines is in case land prices are very expensive, or if people have this concept of NIMBY, not in my backyard, and therefore they want the wind farms to be far away from them. In those scenarios, having offshore wind turbines is, makes sense. But in most geographies, onshore wind and onshore solar are cheaper by far. So it really depends. Now, hydro, to the extent you already have built a dam or something a long time back, then the variable cost of running a hydro plant is very low. But otherwise, building a new hydro plant can be quite expensive. And the same applies to nuclear power as well. So today, I would say in most countries, solar is the cheapest. And in some countries, wind might be cheaper than that. But usually, it's a pretty close run thing between the two.
Well, Carol mentioned in her introduction, that more than 600 million people around the world live in the dark. Take us to what your company is doing in India and how it's helping to facilitate the energy transition there, because we know that's a country that is among the, when it comes to global CO2 emissions, it's at the top of worst polluters.
Yeah, that's right. Look, and India is the third largest emitter of carbon dioxide now in the world, accounting for about 7 to 8% of all carbon emissions. And India just is at the beginning of its development cycle in a way. And over the next 20 to 30 years, we might grow 4 or 5 times of where we are. Now, if we grow in a way that has been as carbon intensive as every other country's growth, then you can imagine that carbon emissions are going to go up dramatically. So I think it's actually very, very heartening that the Indian government has taken a very strong view that we want to grow in a fundamentally different way, and that the whole energy transition, moving from fossil fuels, which are carbon intensive, to clean energy, which is non-carbon intensive, is actually a very strong decision that the government has taken. And it is an area where India can actually, by developing local industries, can actually become a global leader. And so that's the direction that we're likely to go in. Now, what that means is that India's power demand is growing at about 6 to 7% every year. We have to add almost 50 to 60,000 megawatts of renewable energy capacity every year. Now, to give you a sense, that's almost a quarter of the total amount of renewable energy that is getting added every year all over the world. Right. So that's how much we have to add in India every year to make sure that we meet just the future demand growth from renewable energy sources.
Forgive us, we have to break in, but Sumant, come back soon. I'd love to continue. Both of us would love to continue this conversation with you. Sumant Sinha, founder, chairman, and CEO of Renew, trades in the U.S. as an ADR under RNW. We thank him for his time.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, we've got just about 18 minutes left in today's trading session, and I don't know, can I say what John Arthur said?
Yeah, say it.
He said it's kind of boring. You know, we're kind of waiting
was that
for
on
what...
air that he said that, or was it?
I don't
No,
remember.
I think it was during one of the breaks.
Sorry, John.
That's okay.
No, but it's like... It makes sense. And
hurry up and wait for Wednesday, right?
Exactly. And we often talk about that. And we're definitely seeing it in the equity trade. Call it pretty much unchanged on the major equity averages. Continuing to keep a watch, certainly on the treasury trade. And Charlie just, breaking down some of the numbers. What's our 2-year note right now at 5.05 and our 10-year note at 4.31. So definitely have seen yields moving up a little bit. But let's talk a little bit about the markets.
Yeah, we got Thomas Martin with us, Senior Portfolio Manager at the Registered Investment Advisor, Globalt Investment, with us on Zoom from Atlanta. Good to have you with us, Thomas. How are you?
I'm good. Great to be on. Thanks for having me.
Sir, Carol and I correct in our assessment of today's trade? Hurry up and wait for the Fed?
I don't really know what they're waiting for. Everybody knows what the Fed's going to do. It's almost 100% probability.
I think it's a summary of economic projections, right?
Right.
Well, don't you wonder about what will Jay Powell decide to stress in his often brief statement, but then in the Q&A? What will be the thing that he kind of goes back to again and again? Is it data dependent? Is it what is it that he continues to turn to? What is it that you think he might or that you're watching out for?
Yeah, well, he always seems to stress that without getting inflation right, nothing's going to be right in the economy. And I don't know that he said that the last time that he was on, but he's sure to say that frequently, along with data dependence for what they're going to do. And he wants, I think, to deliver the message that it's just very important to keep the pressure on inflation. And, as they say, the work is not done yet. We still have more to do. So they may hold, but, I think the message is going to be higher for longer.
So what's the dot plot going to show us?
We're looking for the dot plot to continue to have one more rate increase in there before the end of the year. But, it's an amalgamation of 14 different dots, and it'll probably be pretty close to evenly split. And the markets are reflecting that as they discount, what's going to happen with rates in the future, about a 40% chance of another rate hike before the end of the year. So they want to keep the pressure on. They want to give the message that, they are not asleep at keeping inflation under control, but they also don't want to scare the markets too much by, over tightening or being overzealous.
Hey, Thomas, I know it's hard to make generalizations. You've got different clients and different investors, and they all have potentially kind of different goals, different missions, different timelines. Having said that, what's a good model portfolio right now?
Well, for most people, when they look at their total portfolio, it's as you said, it's some combination of shorter term needs and hopefully a lot of longer term needs. So the traditional 60-40, 70-30, 50-50, some kind of mix where you have substantial exposure to equities for the longer term, but also have some money that will weather the storm should something unexpected come up and equities take a dive. So it's always important to have a little bit of cash in the portfolio for those next 6 to 9 months to a year.
A little right now or a lot? Just a little?
We're overweight. So our standard weighting in a portfolio is 5% cash, which is, really not that much for somebody in case something, goes completely awry. But then you have other investments like fixed income that you want to have a little bit more of, so you can have 2-3 years worth of what your cash needs are in case, we have a prolonged downturn, which we're not expecting at all right now.
I was just going to say, what could be the cause of a prolonged downturn?
Well, it's those things that everybody's been worried about and that haven't come home to roost for years, really. So we had the pandemic and we had the great financial crisis. We've worked our way through that. But the way we did that was through a lot of fiscal excess. And let's just call it what it is. There's a lot of government borrowing out there and a lot of money that was distributed. And the Fed's balance sheet is very large. Those things all need to come down, especially when interest rates are not 0, but 5%. That interest cost on that debt is what we're all waiting for, whether it's the U.S. or corporations or banks or whatnot, is that prolonged stress of having to make these higher interest payments.
Well, in terms of the rate environment, which is so important in terms of how we value things and just kind of our outlook, what it costs us, whether it's, corporate debt, whether it's individual debt, do you think we stay on that 10-year, we stay above 4% easily for a while?
It makes sense to me that we do. The reason for going below that is probably an unpleasant reason, because something did go wrong, and all of a sudden the 18 to 24 month lag starts kicking in, and there's no pricing power for companies anymore, and consumers pull in their horns. They can't spend, they don't have the money, they have too much debt, the student loan payments are coming due, and then unemployment goes up, and that sort of starts to spiral. And then the Fed says, oh my goodness, higher for longer, longer has come, and we need to start lowering rates. But to the extent that the economy is as resilient as it has been, and that the employment situation stays good,
right?
A normalized level of rates is in between 4 and 5% for the 10-year.
I love that you said that. I mean, it's
welcome
like,
to the new old normal.
I used to, exactly.
Yeah, right.
But I remember I worked with a colleague years ago, and he'd be like, listen, I remember my mortgage, he's a little bit older, sorry, Mike. Not Mike McKee, though. Different Mike, not here anymore. But anyway, he would say my mortgage rate, he was paying a 15 or 16% mortage rate. So like, folks.
You got to refi if you had a 15.
He couldn't, though. I think he eventually did. 30 seconds left. Thomas, you do have a positive bias towards equities for now. Is there a particular sector or sectors, just quickly?
Well, we still like large cap, and we still like growth. And,
large cap or mega cap?
Well, mega cap is a big part of the large cap. But mega cap's up 37% year to date. And that's why we're seeing some of these names just have some of the air let out of them. NVIDIA, month to date down 15%. But that stock was on an absolute tear. So we're going to see some real consolidation here, some real opportunities for people to gain exposure to these. But these are the generals. They're the ones that let us in. They're going to be the ones who lead us out. And
even if you see somewhat of a correction, NVIDIA is still up, 200% this year. So like you say, perspective. Thomas Martin, thank you so much. Senior Portfolio Manager at the RIA Globalt Investment, joining us on Zoom in Atlanta. Perspective.
Yeah, we got to keep perspective.
We should write a book, Perspective.
Okay.
All right. Let's
co-author.
Exactly.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.